Thank you, Shukji. Hello, students. Good morning. A very warm welcome to today's session. So, the topic for today is India's 1 and the India's 34, right? So, these are the two standards which we, uh, use for presentation of our financial statements preparation, right? So, India's 1 is the main standard which, guides the overall presentation and what are the minimum line items which all statements we need to prepare while preparing the India's financials. And India's 34 uh, tells us how do we go ahead and prepare the condensed financial statements while doing the interim financial reporting, right? So these are the two standards for uh, discussion today. So I'll try to quickly revise the concepts from these two standards first before we actually jump into the practical questions on these standards. Give me a second. So as you know, the objective of India's 1 is, to prescribe the basis for the presentation, right? So this already, we have studied in our regular classes, right, in detail. So what do we mean by the presentation? So presentation means how we are going to prepare and present our financial statements under the IndAS, right? And what all statements would be, considered as the part of this financial statement set, right? So what are those items? So IndAS 1 says that you need to prepare the entity's financial statements for the current year along with the comparative numbers for the previous year, right? So it ensures the comparability within the same entity across the different years, right? So you must have already been preparing the India's financials. So you must always be presenting the financial statements numbers for the current year as well as for the previous year, right? So it ensures the comparability among the different periods for the same entity, as well as because many of all the entities are preparing now financials under the IndAS, right? So we can compare the financial performance of one entity vis-a-vis the financial performance of the other entity who is also preparing and presenting the financials under the IndAS, right? So this ensures easy comparability for across periods for the same entity, or for one entity with the other entity within the same sector or same industry, right? For example, peer companies. So this ensures the comparability so that we get to know which company is doing better among a group of companies, right, by comparing their financial performance, right? And that's how investors or users of the financial statements will be able to take the informed decisions, right? So that's the objective. Now, what IndAS 1 actually does to meet all these requirements? So first of all, IndAS 1 tells you what are the overall requirements while preparing the financial statements. It guides the structure, which structure or what sort of structure we need to follow strictly, so that our financial statements are streamlined, right? And it is not that we are preparing one way this year, another way, or next year, right? And there are certain minimum requirements which have to be followed mandatorily by all the companies while preparing and presenting their India's financials. So what do we mean by the minimum requirements? So minimum requirements means these are the minimum line items which you anyway need to present on your financial statements, right? And there are certain disclosures as well. Now, what is the scope? Are all entities covered to required to apply the IndAS 1, or it is based on some selection, or are there any exceptions or exemptions to this? No. So any company who is following IndAS, right, or who is preparing the financials under the IndAS mandatorily have to follow IndAS 1, right? So there is no exception or exemption for IndAS 1, right? So whether you are preparing the standalone financial statements or you are preparing the consolidated financial statements, right? So under IndAS 110, you must have, studied that we do prepare the consolidated financial statement. So if you are preparing the consolidated financial statements as per the IndAS 110 requirements, then also you need to follow the IndAS 1. And if you are not preparing the CFS but are preparing the FSS, separate financial financial statements as per Ind AS 27, then also you need to follow Ind AS 1, right? So Ind AS 1 doesn't tell you whether you need to prepare the separate financial statement or the consolidated, right? But it tells you if you are preparing the one, then how the presentation would look like for these financial statements, right? So that's the scope of the standard. Now, Ind AS 1 does not apply to the structure or content of the condensed interim financial statements because Ind AS 1 prescribes the full-fledged financial statements requirements. So it says because there is a specific standard which deals with the condensed financial statement, that is Ind AS 34, which we will cover today only, right? So because that is governed by Ind AS 34 separately, so we don't interfere in that area, right? So if you are preparing the condensed financial statements for any of the intervening period, right? For example, quarter or half year, right? Then you need to follow Ind AS 34 unless and until you opt for preparing the complete set of financial statements. So even for a quarter or the half year, if you are opting to prepare the complete set of financial statements, then Ind AS 34 will go away and Ind AS 1 will become into the picture, right back. But unless and until you opt for preparing the completed financial statements, if you are only preparing the condensed financial statements, then Ind AS 34 will apply and Ind AS 1 will not apply to the requirements of that condensed financial statements, right? Okay. Now, what all statements we are going to prepare under the Ind AS 1? So Ind AS 1 says you have to prepare the balance sheet, right? A statement of profit and loss, a statement of changes in equity, a statement of cash flows, and the notes comprising significant policies and the other explanatory information. So what do we mean by these statements? So balance sheet, anyway, you know, right? So balance sheet presents the closing balances of all the assets and liabilities, right, on a reporting date, right? So it is the balances of all your assets and liabilities and equity, right, on the closing date. Statement of profit and loss showcases the performance of the company over the period, right, or over the year. So if you are preparing the financial statements for the year end 2026, March ended March 26, then it means if you are preparing the balance sheet, so balance sheet depicts the overall balances of all the assets, liabilities, and equity as on that date, and the P&L, statement of P&L represents the performance over this year, right? How much revenue you have earned, how much other income you have earned, what all expenses the company has incurred, what is the profitability of the company, right? Are there any, other distributions the company has done? So all that will be coming into the P&L. And statement of profit and loss includes the statement of other comprehensive income, right? So statement of P&L and statement of other comprehensive income, right? So both the statements you need to prepare. Then the statement of changes in equity. So what does this statement mean? So this statement tells what are the movements in the equity during the year. So you'll start with the opening balances of your equity and the other equity. Other equity means all other reserves, for example, revaluation reserve, general reserve, retained earnings, all that stuff. So equity and other equity opening balances, additions, deletions, movement during the year, and the closing balances. So this would be depicting the picture of your other equity and equity movement during the year. Then the statement of cash flow you are well versed with. We have been preparing the cash flow statement under the IGAP as well, right? So cash flow statement clearly tells the picture of the cash inflows and cash outflows during the year and the closing cash balance, right? So we'll start with the net profit, whether we can start with the profit of before tax or we can start with the profit after tax as well. So, right. So that is the free choice available to us. By whatever measure we start, we will be, adjusting all the non-cash items, right? And then we'll be doing the operating we will be calculating the operating cash flows after adjusting working capital changes, right? Then cash flow from financing, investing activity, and then cash flow from financing activity, right? So once you are done with the computation of all the cash inflows and outflows from these three activities, you would be ending up with the closing cash balance, right? So this is how the cash flow statement is prepared using the indirect method mostly. And what does this statement tells to the investors? Why we are preparing? What is the objective? The objective is to showcase the sources of fund and the utilization of funds, to the investors, right? And lastly, the notes comprising significant accounting policies and other explanatory information. So what we are going to present in the notes, so all the detailed disclosure required by all the indices which we have followed while preparing the financial statements, all those disclosure will form part of these notes to accounts. And we have to present our accounting policy choices. So what do we mean by accounting policy choices? For example, under India 16, you have the option either to follow the cost approach, cost model, or the revaluation model. Now, if the entity chooses the cost model, they need to state their accounting policy for the property, plant, and equipment, right? Or if they have opted for the revaluation model, they need to state that they have followed the revaluation model. How do the investors will come to know which accounting policy choices you have made under the various indices or various standards, right? So that's why we are going to present all our accounting policies, right, for all the items which are sitting in our balance sheet, right, and the P&L. So this is how it India's one mandates the preparation of all these complete set of financial statements whenever the entity is preparing the financials under the Indias, right? Now, what are the general features? So general features, the presentation should, depict the true and fair view and the compliance with all the indices. Do we have a choice not to comply with any of the indices or any of the requirement of a particular index? No. We have to be compliant with 100% requirements of all the indices mandatorily, right? So that is the basic requirement from index one. Going concern, anyway, so these all these assumptions are more or less similar to what we have studied and followed under the IGAP framework as well, right? So we prepare the financial statements assuming the company will continue at least for next 12 months, right? So that is what going concern assumption is, basis on which we prepare the financial statements. If this assumption is not in place, then we wouldn't be preparing financials the way we are preparing, right? Accrual basis of accounting, we don't follow the cash basis, right? We accrue all the expenses, we accrue all the income, even if those are not received or paid, right? Materiality and aggregation. So we generally follow, the materiality. Immaterial items we can certainly, ignore to be, strictly for spending much of the man hours on that, right? Aggregation, disaggregation we can do wherever there are options available. Offsetting, right? Frequency of reporting we need to choose. So minimum we need to prepare the financial statements at the year end, but we can opt for preparing financial statements for some other frequency as well. For example, a company can choose to prepare the financial statements every 6 months, right? So that is the frequency they can choose, right? For all the listed companies, anyway, it is mandatory to report the condensed financial statements or the financial results on each quarter. If they are equity listed, if they are debt listed, not equity listed, 6 months is the frequency, right? As per the SEBI requirements. So that is all about frequency of reporting, right? Now, consistency in the presentation is the key, right? So we shouldn't be switching from one accounting policy to another accounting policy across the periods, right? Because it distorts the picture of the financial statement. So whatever the accounting policies we have chosen, we should be consistently following them unless and until we believe the other accounting policy has more reliable or relevant in our case, and hence we want to switch to a different accounting policy, right? So it's not like that we have a free choice available with us. Whenever we want, we can change the accounting policy. It is not that. As per the India's 8, it has to be either more reliable or more relevant, right? So those conditions needs to be met and demonstrated before we go and change the accounting policy, right? Comparative information, I already mentioned that we need to give anyway, right? Because we present two columnar balance sheet, two columnar profit and loss, two columnar cash flow statement, right? And all the notes, right? So this is the common practice which we have been doing since ages. Now, if you are changing any accounting policy, then what it will result into? So whenever we change any accounting policy in any of the year, then it results into retrospective restatement or reclassification as per the requirements of the Ind AS 8. So Ind AS 8 has clearly stipulated the requirement that if you change any of your accounting policy ever, then you have to give effect retrospectively, right? So that you must have already studied under the Ind AS 8 session, right? And in that case, what additional requirement gets triggered? To present the third balance sheet, because you are changing an accounting policy. So third balance sheet would also be required, right? So we need to present the third balance sheet in that case. Presentation of the true and fair view compliance, true and fair view and compliance with Ind AS. So we have to ensure that whatever the financial statements we are preparing and presenting under Ind AS, it has to be compliant with all the Ind AS requirements, and it should give a true and fair view, right? Now, to ensure that our financial statements are depicting the true and fair view, so what we need to do to ensure this? So we have to select and apply the accounting policies which are most relevant for our company or business, right? In accordance with the Ind AS 8, right? So Ind AS 8 says that you need to select the accounting policies which are most relevant and reliable for you, right? So if the company is believing that there is no much revaluation movement in terms of their PP&D over the periods, then probably they can stick to the cost model, because fair value gain or revaluation gain or loss is not that significant considering the nature of the property, plant, and equipment the machine company has, right? So there is no point in having the revaluation model accounting policy in that case, right? So company can continue with the cost model. But if another entity which believes that the fair value of their property, plant, and equipment, significantly increases or decreases, over the periods, because they are prone to those changes, and the changes are big enough to capture, right? Then probably it would be better for them to go ahead and select the revaluation model, right, under Ind AS 16. So this is how we need to ensure that which accounting policy choices we are making, are they more relevant and reliable for us, or we are just selecting them for our advantage, right? So the objective should be the relevance and reliability, right? So that's what the standard says to depict the true and fair view of your financial statements. To present the information in a manner that provides relevant, reliable, and comparable and understandable information, right? So we should be preparing the financial statements and presenting them neatly, right? So that users of the financial statements will be able to comprehend the financial statements, right? So if we are giving any notes, then we need to do the cross referencing, right, with the numbers in the financial statement to the notes, so that users of the financial statements can go to that note number directly and read what additional information we are providing to a particular line item in the financial statement, right? So this makes the presentation, easily understandable for the user, right? So these are the things which we need to keep in our mind, right? And to provide additional disclosures if required to enable users to understand the impact of a particular item. So although all the indices do have their minimum disclosure requirements, right? But still, if we believe that we need to explain a particular transaction or a particular item, in more detail, so that users of the financial statements will be able to understand the impact of this item or this transaction, easily, then probably we should go an extra mile and provide certain additional disclosures where it is helping the users of the financial statements. But we shouldn't be unnecessarily over flooding the financial statements with unnecessary detail which are of no relevance, right? So that's is the balance which we need to strike while preparing the financial statements. So right, so neither the financial statements should be missing on any important piece of information, nor it should be over flooded with unnecessary detail or information, right? So that's the balance which we need to strike, right? At this stage, if there are any questions, happy to discuss. I'm just taking a pause. Okay. Now, there would be certain disclosures as well, right, which are required by the Ind AS 1 as well, apart from the disclosures which we are going to make anyway under the other Ind ASs. So what are those? Management conclusions that the financial statement presents a true and fair view. So we have to give a explicit and unreserved statement in our Ind AS financial that the financial statements are in compliance with all the Ind ASs, right? And they are depicting the true and fair view. Then management's compliance with all the Ind AS, and there is no departure from any of the Ind AS requirement, right? That we need to ensure. The title of the Ind AS, in case there is any departure, we need to disclose the nature of the departure, how the particular accounting item is accounted for, reason for the departure, and what is the treatment adopted in that case. These are the applicable disclosures. In case there is any departure we have made from any of the Ind ASs, ideally we shouldn't be landing in any such position in practical life, right? And for each period presented, the financial effect of the departure of each of these items on the financial statements, right? Although we shouldn't be facing such a situation where we need to give this additional disclosure of the departure from any of the Ind AS requirement related, right? Then, of course, all these discussions are explained well in the detail. What is the going concern? What is the accrual basis of accounting that I have already discussed, and current non-current classification I'm going to cover now, right? So that's all on the quick recap of the Ind AS. Let me switch back to okay. Now, you must have studied under the Ind AS 1 session that suppose if a company has taken a loan, right, from any of the banker or the lender, then they need to be in compliance with the clauses which they have signed in as under the loan agreement with that banker or lender, right? Now, in case the company defaults on any of the covenants or the clauses of that agreement, then what will happen? The lender will come and ask for his money, right, back to them, right? So they don't want to, continue with the loan, right? So in that case, what will happen? The loan becomes refundable upfront, right? Otherwise, the loan would have been, a long-term loan, say 10 years or 15 years loan. But because the company has breached a covenant which was specified in the loan agreement, and now because of this breach, the lender can demand the loan repayment immediately, right? So what it results into? So this situation results into the long-term loan which otherwise would have been presented as a non-current liability on your balance sheet, because the covenant breach, it has become refundable immediately. So it has uh, become a current liability for the company, right? Do you agree with this fact? Now the standard says that if such covenant is breached, right? Suppose we are preparing the financial statement, say for 1st of April 25 to 31st March 26, right? So this is the financial year for which the financial statements are being prepared. Now, loan was to be presented. We are preparing this balance sheet. Loan was to be presented as long-term liability. Suppose 100 rupees. Okay. So if the breach was not there for any of these covenants, now because the company has breached a particular covenant, and hence the banker or the lender can demand this 100 rupee loan immediately, which otherwise would have been repaid in 10 years. Now, the company was presenting this as long-term liability, right? But India says because you have breached a covenant, which results into turning this long-term liability into your current liability, that is non-current liability into current liability. So in case you go ahead and continue to present it as a long-term liability, then it will be misleading for the users of the financial statement. So what we need to do, although the banker or the lender has not yet raised the demand on you, right? But they can raise the demand anytime, right? But we shouldn't be taking the advantage that because we have not received the demand letter, so let's continue with the long-term liability. So standard says, irrespective of the action of the lender or the banker, right? Because you have breached the covenant, and you know you have this loan has become repayable immediately in case the lender demands. So while preparing the balance sheet on 31st March 2026, you should be presenting this liability as current liability. So that is the requirement of Ind AS 1, right? Now under the IGAP, what we were doing, we were simply continuing with the long-term liability, because there was no such concept that if the covenant is breached, we should be looking at the classification of these long-term liabilities, whether they are becoming the current or not, right? So there was no such discussion under the IGAP, and hence companies, whether in default or not of any of the covenants, they were just not paying attention to that, and they were simply continuing with the usual classification which they have opted for in their balance sheet, right? But under the Ind AS, this is, this needs to be focused, right? So we have to see if there are any breaches for any of our long-term liabilities, right? Then whether they are resulting into the reclassification. If the answer is yes, then we need to present those liabilities as current liabilities rather than continuing with the long-term liability presentation. Now the standard says, in case the company takes the approval or the waiver, right? Suppose I have defaulted. So this is the year 1st April to 2025 to 31st March 2026. Suppose I defaulted on 30th January, right? 2026, right? 2 months prior to the year end close, right? And on 30th January, I defaulted on one of the covenant, and the liability, the long-term liability, because of this breach of covenant, turns current liability from non-current, right? By the Ind AS 1 implications. Now, Ind AS 1 says, in case the company's management goes to the lender, right, and takes the waiver approval, waiver letter, right? NOC, that boss, sorry, we defaulted on this time. We would be, making it back, and we will not be defaulting again. Please allow a waiver from your right to demand this loan immediately. And suppose if the lender agrees and they give the waiver, okay, we are not going to demand our loan. So they have provided this waiver to the management in writing, right? By virtue of getting this waiver letter of their right to demand the loan upfront, we can continue to present this loan as long-term liability in that case, right? Now, the question is when the waiver needs to be obtained. So the older Ind AS 1. So Ind AS 1 older version with before amendment, right? So Ind AS 1 older version before amendment was saying that this waiver can be obtained before the approval of the financial statements, right? When the approval happens, generally in the board meeting, right? So when the board of directors approve in case of a company, or the approving authority in case of any other, structure, right? So older version of Ind AS 1 said that waiver needs to be obtained on or before the date when the financial statements were approved by the approving authority, right? So in case of company, financial statements are approved in the board meeting by the board of directors, right? So suppose the meeting was happening on for the 31st March financial year to approve, say on 15th of June, right? So if we take the approval even on 15th of June before the board meeting is convened, right? Then we can continue with the long-term presentation because the waiver was obtained prior to the approval of the financial statements date. So that was the pre-amendment era of Ind AS 1. Now the amendment, is coming, has come to the Ind AS 1 last year. And by virtue of that amendment, this waiver has to be obtained before the year end itself, that is 31st March, right? 26. So if you have approved the waiver letter even on 1st of April 26, then the waiver will not be fruitful or helpful for you to present the liability as non-current, right? So if in your examination, suppose question comes on this waiver, so you need to keep in your mind that earlier older version prior to amendment of the Ind AS 1 said that waiver could be obtained before on or before the approval date of the financial statements. But now the revised version or amended version of Ind AS 1 says that approval has to be obtained or waiver has to be obtained on or before the year end itself. Is that clear to everybody? Right? Now, why the Ind AS 1 was allowing the extended period earlier, and now what has changed that? So the corresponding standards are IFRS, from which we have converged, right? So IFRS always said that waiver letter has to be obtained on or before the reporting date, right? Or the year end. But initially we took the carve out that in Indian companies case, let's allow some grace period, right? So even if it is obtained before the approval of the financial statements by the approving authority, then probably we can continue with the long-term presentation. But now the carve out has been removed. And by virtue of removing that carve out, we, are aligned with the IFRS, right? So IFRS always said that approval letter or waiver letter has to be obtained on or before the reporting date. Now under the Ind AS as well, the same thing has, been followed, right? So for your examination purpose, the waiver letter has to be obtained on or before the reporting date. Is that clear to everybody? Right? So whatever I have just discussed is, uh, I have, presented through this example for your future reference and revision. Okay. Now let's see one more example of this. Short-term loan, which was maturing on 31st of December 2025, refinancing agreement was signed on 15th of January 2026, and the financial statements are being prepared on the 31st December 2025, right? Now, because the loan was a short-term loan which was maturing on 31st December, right? And we have got into the discussions with the management, right? And we somehow managed to refinance the loan, right? And the refinance agreement was signed on 15th of January only, right? Now, while preparing the 31st December financials, if this short-term loan, which was maturing on 31st December, right, was not paid and is still outstanding, then where it will be shown, the current or non-current? So it will be shown as current because it is payable on the reporting date, right? But because the refinancing agreement is signed on 15th of January, so for the next year, it will be switched back to the non-current for the next year. But for the current year, it will continue to be shown as current liability, right? So before the amendment, entities were taking the advantage of, the refinancing, which was virtually certain, right? So because entity can say that on 31st December, we have the refinancing discussions ongoing and, we will be getting it in some time, right? So taking the advantage of these discussions, right, which are verbal as of now, and no contract refinancing agreement is signed, the companies still were able to say that, okay, because this is bound to be signed, it's just a matter of some modalities or formalities which needs to be executed first. So let's go ahead and change the presentation from current to non-current. So earlier it was possible, but now after this amendment, it is not possible. So after amendment, it says that it has to be classified as current liability only on your balance sheet, right? Unless and until the refinancing agreement is signed on or before the reporting date, right? So that is the another situation where current non-current classification, we need to be very careful, right? So I hope this recap and the amendments on the India's one was helpful uh, for you to revise, right? Now let's start with some practical questions on the India's one. An entity has placed certain deposits with various parties. How the following deposits should be classified? Whether we need to classify these as current or we need to classify as non-current. What do you think? Electricity deposit, tender deposit, earnest money deposit, or the GST deposit paid under the dispute or the GST payment under dispute. So just giving you a couple of minutes to think through how we are going to present these deposits on our balance sheet, current assets or non-current assets. That's the question. Okay. I hope you must have formed your view on these three items. So let's quickly discuss. Electricity deposit. At all points of time, the deposit is recoverable on demand when the connection is not required. However, practically, the electric connection is required as long as we are into the business, right? So we are not winding up the business and hence we wouldn't be going to the electricity department asking for the deposit refund. Since we are not expecting to wind up our business, right? And therefore, we are not expecting the deposit refund, right? Hence, electricity deposit will always be considered as the non-current asset, right? Because it is not realizable within next 12 months from the reporting date, because we are not going to wind up our business and hence we are not asking for the electricity deposit refund anyway. Clear? Easy one. Tender deposit, earnest money deposit. What earnest money deposit is? So tender deposit or earnest money deposits are paid for the participation in various bidding, right? So if we were bidding for something, then we deposit certain amount that in case we win, then we can be made, responsible to execute the contract after the bidding we have won. This they normally become recoverable if the entity does not win the bid. So as and when the bid results are announced, and if our name is not in there in the awardee list or the winner list, then these deposits are becoming refundable, right? Bid dates are known at the time of applying for the bid or tendering the deposit, but until the date of the actual bid, one is not in a position to know if the entity will be winning the bid or not, right? So, because we cannot clearly say that whether we are going to win the bid or we are not going to win the bid, right? Accordingly, depending on the terms of the deposit, if the entity expects to realize the deposit within next 12 months from the reporting date, it should be classified as current, otherwise non-current, right? So basis on the facts and circumstances, if the company believes that the bidding results will be announced, say within 9 months or 10 months from the bidding date, and hence, and the more chances are that we will not be winning, so probably we can continue with the current presentation. But if we do not believe that we wouldn't be winning, then we have to see what would be the real outcome. Basis on that we can classify. Until then we can go ahead and present the non-current, right? GST deposit paid under the dispute or GST payment under the dispute. So there is a dispute with the GST department, and there are certain payments which you have made under the dispute, right? Unless it until the dispute or the order of the court comes, right? This deposit is paid. What do you think? Current, non-current? So classification of the GST deposit paid to the government authorities in the event of any legal dispute, which is under protest, would depend on the facts of the case and the expectation of the entity to realize the same within the period of 12 months. So in case the entity believes that within next 12 months, the decision will arrive, highly likely to arrive in our favor, and hence we will be getting this refund. Then it means entity expects this refund of deposit will be materialized within next 12 months from the reporting date. Then it can present as current. Otherwise, it has to present as non-current. So by default, presentation would be the non-current until the entity is able to demonstrate that they truly believe that this deposit will be refunded to them within next 12 months from the reporting date. Right. So if they believe so, they are able to demonstrate, then current. Otherwise, deemed presentation is the non-current. Perfect. Let's do this question. Question number 2. An entity has taken a loan facility from the bank that is repaid within the period of 9 months from the end of the reporting period. Prior to end of the reporting period, the entity and the bank enter into an arrangement whereby the existing outstanding loan will unconditionally roll into a new facility which expires after a period of 5 years, right? How should such loan be classified in the balance sheet of the entity? Will the answer be different if the new facility was agreed upon after the end of the reporting period? Will the answer be different if the existing facility is from one bank and the new facility is from another bank? Will the answer be different if the new facility is not yet tied up with the existing bank, but the entity has the potential to refinance the obligation? So these are the 4 scenarios under which you need to articulate your answer. What is the presentation required? Current, non-current. So what is happening? We have taken a loan which is to be repaid within the 9 months from the reporting date, right? So my reporting date is 31st March 2026, and within 9 months, it has to be repaid from the reporting date. Now, facts of the question says within 9 months, so it means it is refundable within 12 months from the reporting date, much prior to the 12 months. So it is a current liability, right? By default. So the loan is not due for the payment at the end of the reporting period. The entity and the bank have agreed upon for the said rollover period to the end of the reporting period for a period of 5 years. Since the entity has unconditional right to defer the settlement for the liability at least 12 months after the reporting, the loan should be classified as non-current. Now, what is happening? Generally, as per the general term, the loan was refundable within 9 months from the reporting date, and hence it was to be classified as current. But what has happened? Bank and the entity entered into an arrangement whereby the extending loan will be unconditionally rolled into a new facility which will be maturing or expiring after 5 years from the reporting date. Now, 5 years is more than 12 months from the reporting date. So, because this agreement has taken place, so by virtue of this agreement, the loan which was otherwise would have been payable within 9 months from the reporting date is now becoming payable within 5 years from the reporting date, and hence from the current classification, it will be reclassed to as non-current by virtue of this agreement, right? Will the answer be different if the new facility is agreed upon after the year end, after the reporting date? What do you think? Yes, we just studied, because if the arrangement is taken place after the year end, then on the year end, it was a current liability only, right? So until the arrangement is agreed upon on or before the reporting date, it will be current. Yes, the answer will be different if the arrangement for the rollover is agreed upon after the year end, because assessment is required to be made basis on the terms and conditions of the loan existing on the reporting date. At the end of the reporting period, the entity does not have the unconditional right to defer the settlement of the liability for beyond the next 12 months, right? And hence the loan has to be classified as current in this case. But for this year, it is current, but next year, it will again be non-current, because still 4 years will be left, and 4 years is much more than 12 months from the reporting date, right? Because the refinancing agreement has entered into after the year end. So for this year end, it will be current, but for the next year end, it will be presented as non-current, correct? Third situation, in case we get it refinanced from another bank, doesn't matter. So first bank loan was balance transferred by other bank. The loan is anyway sitting in our books, right? So it will not be treated as the refinancing, but it will be treated as altogether the new loan from the new bank, right? And basis on the terms and conditions of the new loan from the new bank, we will classify if it is still repayable within 9 months from the reporting date, current. If it is repayable after 12 months from the reporting date, then non-current, right? And the last scenario, will your answer be different if the new facility is not yet tied up with the existing bank, but entity has the potential to refinance? So potential to refinance, but the no refinance has yet been obtained, right? So in that case, as per the paragraph 73 of the India's one, when the refinancing or rolling over obligation is not at the discretion of the entity, for example, there is no arrangement of refinancing, the entity does not consider the potential to refinance as the obligation and classifies the liability as current only, right? So the thumb rule, or in a nutshell, the conclusion is, unless and until we have the refinancing arrangement in hand on or before the reporting date, rest all things are immaterial, right? Any questions at this stage? Happy to take up your queries. Okay, so just for the benefit of all the students, I'm just summarizing what we have learned in the previous two questions, right? You can also note down. If we have any loan on our balance sheet, and we are preparing, say, financial statements for a reporting date, for example, assume 31st March 2026. Now we need to see whether this loan is refundable within next 12 months or after the next 12 months from this 31st March 2026. That is the reporting date. If the answer is it is refundable within next 12 months, then it will be presented as current liability, right? There is no doubt about that. If it is refundable after 12 months from the reporting date, then it will be presented as non-current liability. There is also no doubt about that. Now, what happens if it is refundable within next 12 months, but the entity wants, to refinance it, right, with the bank, and the discussions are going on. So we have to see whether by the balance sheet date, that is the 31st March 2026, the refinancing arrangement was signed between the entity or the bank or not. If the arrangement was not yet signed, and it is signed after the 31st March 2026 or the balance sheet date, then we will be completely ignoring the new arrangement, and we will be sticking to the terms and conditions of the original agreement which was in place on that reporting date. That is the original loan agreement. And in accordance with that, it is repayable within next 12 months, right? So it has to be presented as current only, irrespective of the fact that refinancing discussions are going on. It is virtually certain that refinancing agreement will be signed. It's just a matter of some formalities or modalities, right, which are taking some time. And hence, because of that, we are not able to get the refinancing arrangement signed on or before the balance sheet date. So those are excuses, or, demonstrations are useless as per the India's one. So India's one says clearly see the document. If the document is available on the balance sheet date, go ahead and classify as non-current. If the document is not available on the balance sheet date, then we will ignore whatever the discussions are ongoing between the management and the lender. Is that clear? Right? Okay. Let's do this question. In December 2001, an entity entered into a loan agreement with a bank. The loan is repayable in 3 equal annual installments starting from December 2005. So loan is repayable in how many installments? 3 installments. Installments are annual. That is, it will start from December 2005. Right. One of the loan covenant that is that an amount equivalent to the loan amount should be contributed by promoters by 24th March 2020, 2002, right? So there is a covenant that some amount equivalent to the loan amount should be contributed by the promoters as well into the company by 24th March 2002. So when the loan was taken on December 2001, and promoters have to contribute an equal amount by some extended window, 24th March 2002, failing which the loan becomes immediately repayable to the lender on demand, right? On 24th March 2002, the entity has not been able to get the promoter's contribution, right? So 24th March, until 24th March, promoter's contribution couldn't arrive to the company, and hence, on 25th of March 2022, the entity approached the bank and obtained a grace period until 30th June 2002 to get the promoter's contribution done. Right. So, on failing this covenant on 24th March, entity uh, met the bank officials, discussed the plan and way forward, and agreed upon some grace period to be allowed, and banks allowed. So bank said, okay, let's bring that contribution until 30th June 2002, right? The bank cannot demand immediate repayment during the grace period. So until the 30th June is over, now bank has given, uh, you know, uh, his loan demand rights, right? By virtue of allowing the grace period. The annual period reporting for the entity is 31st March 2002. Now, as on 31st March 2002, how you will be classifying this loan? What is your answer? So, when the extension has been sought on 25th March, on which date balance sheet we are preparing? 31st March, right? So, extension was sought on or before 31st March, right? In this case, and the extension has been granted, right? And the extension grants the period until 30th June 2002, right? So that is the situation. So in this case, what will happen? So here, the entity classifies liability as non-current if the lender agreed by the end of the reporting period to provide the period of the grace ending at least next 12 months after the reporting period, within which the entity can rectify the breach, and during the lender cannot demand the immediate repayment, right? So this is the statement given by the standard under the para 75. Now, in the present case, following the default, so default has already been there. Grace period within which the entity can rectify the breach is less than 12 months after the reporting period. Hence, on 31st March 2002, the loan stands classified as current. Why? Because the grace period is allowed only until 30th June, which is 3 months from the reporting date. So even if, the grace period is allowed, but it is allowed only for 3 months from the reporting date. So in that case, what will happen? Loan stands to be classified as current, at least on 31st March 2002. Clear? Situation number two, assume that in anticipation that the entity may not be able to get the promoter's contribution by the due date, in February 2002 itself, the entity approached the bank before the breach happened and got the compliance date extended up to 30th June 2002 for getting the promoter's contribution. In this case, will the loan classification as on 31st March 2002 will be different from A above? What are your thoughts? So now what is happening in the second scenario? Before the breach of the covenant, the management approached the lender or the banker to allow the grace period. Bank allowed the grace period and they allowed until 30th June 2002. Now what is happening in this case? So in this case, what is happening? Actual breach has taken place or not is to be assessed on 30th June only because the breach has not yet happened. Are we correct in saying that? Because the breach has not yet happened and the breach date in itself is extended to 30th June before the breach happened. So it means we are going to test whether the breach happened or not after the balance sheet date, right? So on the balance sheet date, there is no breach. And because there is no breach, so there is no demand of the loan right with the bank. So bank cannot say that because you have breached on this condition or covenant and hence we are asking our loan back. But because that breach has not yet happened before the reporting date and the breach test date itself is postponed to 30th June 2002, that is after the reporting date. Consequently, in the absence of actual breach on or before the reporting date, the loan covenant as of 31st March, the loan stands reclassified as non-current because unless and until the breach happens, the bank cannot ask for payment. And because the breach has not happened before the balance sheet date, so there is no covenant breach, there is no loan demand possible, and hence loan continue to be uh, considered as non-current in that case. Is that clear? Any questions? Any doubts? Okay, then let's proceed to the next question. An entity manufactures passenger vehicles. The time between the purchasing of the underlying raw materials to manufacture the passenger vehicles and the date the entity completes the production and delivers its to its customers is 11 months. Customers settle the dues after the period of 8 months from the date of the sale. Will the inventory and the trade receivables be current in nature? So, basis on this facts, what is your take on the inventory and the trade receivable? Whether the inventory and trade receivables are current assets in nature? That's the question. Another is assuming that the production time was say 15 months and the time lag between the date of the sale and the collection from the customer is 13 months. Will your answer be different in that case? Now, what do you think in this case? Whether you are going to classify the inventory and the trade receivable as current under the scenario one or non-current, and what your answer would be under the scenario two, where the production time is 15 months and the collection time after the sale is 13 months for the trade receivables. So I'm just waiting for you to think through on this, articulate your responses, and then we will see what is the right answer. Yes. Okay. So let's see. Inventory and debtors need to be classified in accordance with the requirements of Ind AS 1, which provides that the asset shall be classified as current if an entity expects to realize the same or intends to sell or consume it in its normal operating cycle. Right. So that is the definition given by Ind AS 1 for the current assets and current liabilities. If they are expecting to realize the assets and consuming them within the normal operating cycle. Right. Now, under the scenario one, time lag between the purchase of the inventory and its realization into cash is 19 months. That is 11 months plus 8 months, right? 19 months. Both inventory and data should be classified as current if the entity expects to realize these assets in its normal operating cycle. So if the entity says that, boss, this is what our operating cycle is, and by virtue of that, it is our operating cycle and it is happening in within the that operating cycle, then it will continue to be classified as current only, right? Inventory and debtors. But in the situation two, the answer will be same, as the classification of the debtors and inventory depends on the expectation of the normal operating cycle. Now, in the second situation, when the company says that the time lag between the purchase of the inventory and its realization into cash is 28 months, that is 15 months plus 13 months, both the inventory and debtor would still be classified as current if the entity expects them to realize within the normal operating cycle. Now, the standard says that if you are expecting to realize your assets within the normal operating cycle, right? Then they will be current. Now, what the normal operating cycle is, then the standard says the normal operating cycle is to be defined by the company basis on their business. Generally, it is 12 months. So, if there is no different stance taken by any specific industry or the sector, then it will be deemed considered as 12 months. But if it is different, then the company needs to explain, right? So in this case, what is happening, company is saying that the operating cycle they have is 19 months or the 28 months, as the case may be. And by virtue of that, because their operating cycle is this only, considering the nature of their business which they are into, and hence the standard says if the assets are being realized within the normal operating cycle, then it will continue to be classified as current, because we cannot put the 12-month condition on every company, in spite of the fact the company is saying their operating cycle is different from the 12 months. So if the company is not objecting, then the deemed period is the 12 months. But if the company specifies their operating cycle, right, so it is different. So you must have observed, in case of sugar companies or sugar industry, operating cycle is quite different, right? Because of the nature of the sugarcane crop, right? Any questions, any doubts, any queries? Okay, so let's proceed on the question number 5. XYZ Limited, the company, is into the manufacturing of a tractor parts and mainly supplying the components to the original equipment manufacturers, OEMs, right? So what the company is doing? Company is manufacturing some parts which are used by the tractor manufacturer company, to use those parts while producing the final output, which is tractor, right? So they are basically the original equipment manufacturer for certain tractor manufacturing companies. The company does not have any subsidiary, joint venture, or associate company. During the preparation of the financial statements for the year ended 31st March 2001, the accounts department is not sure about the treatment and the presentation of the below mentioned items. Accounts departments approached you as a accounting expert for advice on following matters, right? So you as a chartered accountant need to advise on these matters. Number one, there are qualifications in the audit report of the company with reference to two Ind ASs. So auditors have qualified that the company is not compliant with two Ind ASs, right? So there is a qualification. Another matter is it mandatory to add the word standalone before each of the components of the financial statement? So while preparing and presenting the financial statements under Ind AS, if we are not preparing the consolidated financial statements, then do we need to mention clearly the standalone word on the financial statements? Or if we are preparing the consolidated financial statements, in that case, do we need to mention on our standalone financials the standalone word? Third, the company is an Indian company and preparing and presenting its financial statements in INR. It is necessary to write the financial in the financial statement. The financial statements have been presented in INR. Okay. So if the company is preparing financial statements, which is an Indian company, and the currency of the India is anyway INR, do we need to still mention somewhere on the financial statements that the financial statements are presented in INR? That's the ask. And the fourth, the company had sales transactions with the 10 related parties during the previous year. However, during the current year, there are no transactions with 4 related parties out of the aforesaid 10 parties. Hence, the company is of the view that it need not disclose the it need not disclose the sale transaction with these 4 parties in related party disclosure uh, because with these parties there are no transactions during the year, right? So because the transactions are not happening with few of the related parties, so company believes their relationship or names are also not required to be disclosed on the balance sheet as related parties. So these are the 4 matters on which the expert advisory is sought for. So I'm just giving you a couple of minutes to think through on these items. And then once you are done with your responses articulation, then we will discuss the solution. Okay. So I hope you must have thought through about your responses on these 4 items. Let's see. You can match your response. So in the case 1, what was the matter? The qualifications in the audit report of the company with reference to the 2 Ind ASs. So, an entity whose financial statements comply with Ind AS shall make an explicit and unreserved statement of such compliance in the notes. An entity shall not describe the financial statement as complying with Ind AS unless they comply with all the requirements of the Ind AS. Right. So, this is the requirement from para 16 of the Ind AS 1. Now, the question was because the auditors are qualifying in their audit report that the company's financial statements are not in compliance with 2 Ind ASs, do we still need to make this explicit and unreserved statement on our financial statement? The answer is yes. So irrespective of the fact what the view of the auditor is on your financial statements, right? if the management view is that they are compliant, they have to go ahead and present their financial statements with this explicit and unreserved statement that they believe their financial statements are compliant with all the requirements of all the NDSs, right? So auditors view will reflect in their auditor report, management view will reflect on the financial statements, right? So financial statements are the property of the management, not the property of the auditor, right? So auditors properties, auditors report. So auditors have the right to say whatever they want to say in their audit report, right? But management has all the rights to say whatever they want to say in their financial statements, right? So in the financial statements, in the notes to accounts, the reserve, unreserved and explicit statement of compliance with all the requirements of the NDSs still will go irrespective of the fact whether the auditors are qualifying their audit report on the India's compliance or not. Is that clear? Second one, is it mandatory to add the word standalone before each of the components of the financial statements? The answer is no. So we don't need to mention the standalone word everywhere, right? But need to disclose in the financial statement that these are individual financial statements of the company, right? So we don't need to mention the standalone word everywhere, but somewhere on the financial statements, we need to state that these financial statements are the standalone financial statements for the company or the individual financial statements of the company. Is that clear? So we don't need to say a standalone balance sheet, a standalone profit and loss, a standalone cash flow statement, a standalone explanatory notes. No, we don't need to mention the standalone word everywhere on the financial statements, but somewhere on the financial statements, we need to call it out that these financial statements are individual financial statements of the company, right? Third, third point, the company is an Indian company preparing and presenting the India's financial and Indian currency is INR. Do we still need to mention on our financial statements that financial statements are in INR? Yes. Para 51 of D of the India's one states clearly that the entity shall display. Shall to anyway, means mandatory, right? Shall display the presentation currency as defined under India's 21 prominently and repeat it when necessary for the information presented to be understandable. So are you going to say in one statement somewhere on the financials that financial statements are in INR, or do you need to repeat this rupee sign or the INR word everywhere on all the statements, be it balance sheet, statement of profit and loss, cash flow statement, and all the notes and the statement of changes in equity. So everywhere, wherever you are presenting the amounts, you have to, present the rupee sign or the INR word, right? So that users get to know that everything is in INR only on this balance sheet, right? So we have to repeat it everywhere, wherever it is required to be repeated, right? To avoid any confusions. The fourth one, the company had sales transactions with 10 related parties during the previous year. But during the current year, there are no transactions with 4 related parties out of the 10. So company wants to skip the disclosure of these 4 related parties. No. Related party disclosure will still be made because the transactions were there in the prior year. If the transactions were not there in the prior year as well, then probably the related party name disclosure wouldn't be required. So as per para 38 of the NDS 1, except when the NDS permits or requires otherwise, an entity shall present the comparative information in respect of the preceding period for all amounts reported in the current period's financial statements. An entity shall include the comparative information for narrative and descriptive information if it is relevant to understanding the current period financial. So in the current year, although the amount is nil, but in the previous year, there was certain amount, right, with these 4 related parties. So because we are presenting the comparative information, so we have to give the name and we have to present the current year amount as nil, right? So that is the ideal way of presenting, rather than saying because there are no transactions in the current year, so let's completely ignore these related parties. No, the requirement as per the India's 1 is to present the comparative information as well. As long as we do have the transactions in the prior year or the comparative year, these related parties still have to be disclosed on the balance sheet. Is that clear to everybody? So these are very good questions, selected by institute for your LVRC classes and the revision. So just uh, try to practice them and revise them. You know, these are very good. This brings very good conceptual clarity. Okay, so let's proceed to the question 6 now. A company presents financial results for 3 years. That is one for the current year and two for the comparative years. Okay, so you tell me whether, although the requirement is to present the current year and the comparative year, but still the company wants to present 3 years, can they do so? Yes. If the company wants to present for 3 years, they can do so. Okay. Now, the company presents financial results for 3 years, that is one for current year and two comparative years internally for the purpose of the management information every year in addition to the general purpose financial statements. The aforesaid financial results are presented without furnishing the related notes because these are not required to be managed for internal purposes. During the current year, management thought, why not they should present the third statement of the profit and loss also in the general purpose financial statements. It will save time and will be available easily whenever the management needs them in future, right? So because the management is asking every time the three columnar, presentation of the information, so accountant in the company thought, let's proceed and prepare the financial statements itself for the 3 years, so that as and when the management is asking for this, I will simply hand it over. I don't need to, specifically work on this for the management separately. With reference to the above background, answer on the following. Can the management present the third statement of profit and loss as an additional comparative in their general purpose financial statements? Number one. Ask number two. If the management present the third statement of the profit and loss in the general purpose financial statement as comparative, is it necessary that this statement should be compliant with Ind AS? And third ask, can the management present third statement of profit and loss only as additional comparative in the general purpose financial statements without furnishing other components? For example, the third balance sheet, the third column for the cash flow, the third column for the statement of changes in equity in the financial statements. So three ask, whether we can present the third column in case we wish. Number one, whether that third column is required to be compliant with Ind AS if the we are going to present, and is it possible to present only for the profit and loss, or if we present it for the profit and loss, do we need to present it for all, that is the balance sheet, the statement of cash flow, and the statement of changes in equity? What do you think? What is your call on this? So I'm giving you again a couple of minutes to think through whatever you have learned. Just try to recall from your main sessions and or your revisions you were doing until now, and try to articulate your response on this. Okay. I hope you must have thought through on all these matters. So let's see what is the right answer. As per para 38C of Ind AS 1, an entity may present comparative information in addition to the minimum comparative financial statements required by the Ind AS, as long as that information is prepared in accordance with the Ind AS. So standard Ind AS 1 says under the para 38C that yes, we are allowing you to present the third column, right? So in case you want to prepare the financial statements for the 3 years, that is current year, previous year, and previous to previous year, right? So you can do so, right? If you wish to provide one more column for the prior to prior year, that is absolutely fine with us, as long as the third column is also in compliance with Ind AS, right? So you cannot simply put up anything which is non-compliant, right? So whatever you are going to present on your financial statements has to be strictly in compliance with the all the Ind ASs, right? So this comparative information may consist of one or more statements referred to in the paragraph 10, but need not comprise a complete set of the financial statements. When this in the case, the entity shall present the related note information for those additional statements, right? So third column presentation is allowed under para 38C as long as it is compliant with the Ind AS. The second ask was, if we are going to present and if it is allowed, do we need to comply with the Ind AS? The answer is yes. Give me a minute. Right? So answer is yes. As per para 38C of Ind AS 1, an entity may present comparative information in addition to the minimum comparative financial statements required by Ind AS, as long as that information is prepared in accordance with Ind AS, right? So whatever the third column you are going to present, it has to be in compliance with Ind AS. That is the requirement from para 38C of the Ind AS 1. And the last one, if we are preparing it for the statement of profit and loss, then do we need to prepare it for other statements as well? For example, the balance sheet statement of cash flow and statement of changes in equity. What do you think? So as per para 38C of Ind AS 1, an entity may present comparative information in addition to the minimum comparative information required, as long as the information is prepared in accordance with Ind AS. This comparative information may consist one or more statements referred to in paragraph 10, but need not comprise a complete set of the financial statements. When in this case, the entity shall present the related note information for those additional statements, right? So if you are going to present it, you can present it for all the other statements as well as the notes if you wish so, right? So that was the para 38C. Any questions, any doubts on this? Okay. So that was it on the revision of Ind AS 1 for today. So let's have a break now for 15 minutes and then we will start Ind AS 34 revision. Okay. So we will be back in 12 to 15 minutes. Maybe 8:25 is now. So 8:40. Okay. Thank you, Shochi. So let me quickly share the screen. I hope the screen is visible to everybody. Okay. So the next topic for today is India's 34 interim financial reporting, right? So as I previously said, that India's one guides the presentation requirements for the complete set of the financial statements, while the India's 34 guides the presentation requirements for the interim financial reporting if the company is preparing the condensed financial statements, right? So India's 34 overview is, what is the objective? So objective is to drive the guidance on the interim financial reporting, right? So within the scope of India's 34 is the interim financial reporting. So if the year end financial reporting is happening, then we will apply India's one mandatorily. But for the interim financial reporting, India's 34 is needs to be applied, right? So this standard also prescribes certain minimum components or minimum items which needs to be presented on the financial statements. Forms and content of these financial statements and disclosures around significant event and transactions which have occurred during the interim financial period, right? And certain other disclosures which would eventually be required. So basically, the standard India's 34 says that for the purpose of doing the interim financial reporting, company needs to see all company needs to make all those disclosures which are significant from that interim financial period perspective, right? So if the company is giving all the regular disclosures in the annual report, right? But what out of those, if there are any significant transactions or events which have occurred during this particular period, then disclosures related to those items have to be mandatorily made in the interim financial reporting, while not duplicating all the disclosures which we have give in our annual financial report, right? Now, do we need to prepare the interim financial reporting with the same accounting policies, or we can prepare change the accounting policies in the interim financial reporting? So standard India's 34 says accounting policies have to be same as what we have followed in the annual accounting policies, right? So same accounting policies. But by chance, if the company is changing the accounting policy during the year, then what do you think? Can the company do so? Yes or no? Yes. Provided the conditions or the criteria prescribed by India's 8 are complied with, right? So India's 8 says that when the new accounting policy which the company wants to switch to is more relevant or reliable, then the company can do so, right? So if those conditions are met, or those criteria is met, then the company can switch to the new accounting policy. And then what would be the effect by changing the accounting policy? The retrospective, right? So we have to give the retrospective effect within that quarter in which we are changing the accounting policy. So within that quarter as well, this disclosure around the change in accounting policy will go, as well as when we prepare and present the full year financial statements after the 4 quarters are closed, right? We will again make those disclosures in our annual report too, right? Recognition and measurement related requirements, other requirements. Revenue which is received seasonally, cyclically, or occasionally needs to be recorded in the quarter to which it belongs, right? We cannot do the teaming and lading of the revenue, right? So we cannot say that, boss, this revenue is being received in this quarter is are higher as compared to the other quarters. So other quarters results will look bad. So let's do one thing. Some revenue will recognize in this quarter, some revenue we will recognize in the next quarter. Can we do so? No. So no teaming and lading is allowed for recognition of any of the revenue or the expenditure, right? So whatever belongs to a particular quarter has to be reported within that quarter. No preponement or postponement of these recognition can be allowed, right? Simply that costs which are incurred unevenly during the financial year. So if the cost is incurred in a particular quarter, right, so that will be recorded and in that quarter, or we can simply allocate that cost over the 4 quarters just to streamline our profitability across the 4 quarters. No. So whatever the cost belongs to a particular quarter and is incurred within that quarter has to be recorded within that quarter itself, right? We cannot do any streamlining, right? We cannot make up our profitability, right? And other recognition and measurement principles of all other indices for all the items which we have on our financial statements needs to be followed. And certainly, wherever required, estimates are to be made. Now, give me one example of the estimate. What are the possible estimates the company makes while preparing the financial statements? Expected credit loss is an estimate, right? Provisions are the estimates, right? So provisions, expected credit loss, inventory obsolescence provisions, deferred taxes, or gratuity, leave encashment provisions, all these provisions are estimates only based on certain assumptions, right? So management has to be, vigilant and prudent while making those assumptions to make up those estimates, right? So estimates should be, made with the right set of information the management has, and it should be unbiased, right? So that's the requirement, correct? Now, what are the minimum components of the interim financial reporting? It shall include, at a minimum, a balance sheet, which will be regarded as condensed balance sheet. A condensed balance sheet, a condensed statement of profit and loss, a condensed statement of changes in equity, a condensed statement of cash flows, and selected explanatory notes to accounts, right? So do we need to give all the notes in our quarterly results? No, only selected important notes to accounts, which are critical to be given into the results so that users of the financial results will be able to understand and comprehend the results better way, right? So that's the objective. We are not going to write unnecessary information on the results, right? In terms of notes, right? Only significant related to those transactions or those events which have occurred during the quarter specifically. For example, suppose there is a fire broke out in a particular quarter. Now, do we need to mention a note or disclosure about the fire occurred and the loss damages or not? Or we can simply say that we will give in the annual report whenever we close the year end. What do you think? Do we need to give the disclosure around the fire? Yes. Fire is a significant event. Yes or no? Yes. Because it has damaged your godown or the factory plant. It rendered your plant or machinery unoperational for, next 2 months. So it is significant to your business, right? So all the significant events and transactions which have taken place during the quarter have to be mandatorily reported in terms of notes to accounts on the financial results. There is no, exception to that. Is that clear? Perfect. Interim financial report is intended to provide an update on the latest complete set of financial statements. Suppose if you had already published your annual report for the year ended 31st March 2026. Now you are closing the quarter, April, May, June 26, right? Now you are publishing the results. So if there were any disclosures which were made in your annual report and there are updates because of new events occurred during the quarter to those items, will you be providing those updates in your quarterly results? Yes, because that is the information which users of the financial statements would be interested in to know, right? So it focuses on all the new activities, new events, new circumstances that do not duplicate the information which was already previously reported in the previous quarter results or the previous annual report, right? So the objective is not to flood the quarterly results with unnecessary information or disclosures which have already been made in the annual report, but to disclose all those crucial disclosures which are necessary for the users to know for this quarter related, or in terms of any updates on the previous items which have been reported or disclosed under the annual report, right? So if there are any updates, for example, suppose there was a court law or dispute which was pending under the High Court as at the year-end reporting date. So in the year-end financial statements, we have said that the court order is pending and the provision we have made for 100 crore liability if the decision goes against us, right? So that provision we had provided for in our financial statements. Now in the first quarter, the court order has arrived, right? And that order has arrived in our favor. And accordingly, we have reversed that 100 crore provision now in the quarter one. Now, do you think this is a material item and update needs to be provided on the quarterly results? Yes or no? Yes, because users will be able to understand that the outcome has arrived and it is in favor of the company. And because of that, the company has reversed a earlier provision of 100 crore, which resulted into a profit spike by 100 crore. So that will be justified if we make this disclosure. But if we don't make this disclosure, users of the financial statements will continue to struggle to understand what this spike pertains to in the profit, right? Correct? So this is how we need to demarcate, between what disclosures we need to make and what disclosures we shouldn't be, right? So that's the balancing which we need to strike while preparing the condensed financial statements, right? So that's the requirement of the standard. Now, if my question to you, if the company prepares or wants to prepare, instead of the condensed set of financial statements, a complete set of financial statements, then the company will be complying with Ind AS 1 or Ind AS 34. What do you think? For the quarter as well. Suppose for a particular quarter, company wants to present the complete set only. So in that case, company will have to mandatorily follow Ind AS 1, even for the quarterly financial statements, because the company is not preparing the condensed, company is preparing the complete set, right? And if we prepare the complete set, it means Ind AS 1 has to be complied. My next question, whether the company wants to give, company is required to give all the notes to accounts and disclosures now, or it can still continue with the selective approach of the key matters or key disclosures as stipulated under Ind AS 34, all, right? Because we are preparing the complete set, so we will be giving all the disclosures, right? So it is not, like we are preparing the complete, but we can, take the advantage of some specific disclosures only into that. So either you prepare the complete or you prepare the condensed, right? There is no mix match approach possible, right? Okay. All the significant events and transactions, I took the example of the court order, I took the example of the fire. So all these events, if are significant, needs to be reported, right? What are the other possible events? So this is not the exhaustive list. This is the suggestive list that these are the items which might require to give the disclosures in the quarterly results because they appear to be significant on the face of it. For example, written down value of inventories to NRV. So if you are writing down any of your inventory during the quarter to NRV, right, from the cost, and you are booking that loss on your P&L, are you supposed to make a disclosure around that so that users will understand why exactly this write down has happened? What led this write down on your inventory? Yes, because this is the important item then. Recognition of loss from the impairment of the financial assets, property, plant and equipment, intangible assets or other assets, or any reversal of the previously recognized impairment losses in the quarter. So if you are passing an entry for booking the impairment loss or reversal of an impairment loss which was recorded in the previous years, then will you be making the disclosure around this aspect, or you can simply say, oh, this is not material, let's ignore? No, it is a material because impairment loss recognition as well as reversal is a material item and has to be explained well in the financial statements. The reversal of any provision for any of the prior costs of restructuring which we must have recorded. So like I took the example, provision for court order, you have booked 100 crore, now you are reversing because the decision arrived in your favor, right? So because of that, disclosure gets triggered. Acquisition, disposal. So if you have purchased a significant machinery or equipment during the quarter, would you be making the disclosure that we have made a purchase of machinery worth rupees 100 crore in the quarter? Yes or no? Yes. If you have made any commitments for purchase of any such machinery but not yet purchased, would you be making the disclosure around those commitments made during the quarter? Yes. Litigation settlements, yes. Correction of the prior period errors, certainly yes. Because if you are correcting any of the prior period errors in any of the quarter, when you notice that there are errors in the prior year's reporting, then anyway Ind AS 8 gets triggered, and because of the Ind AS 8 is getting triggered, prior period errors are to be rectified retrospectively or prospectively. What do you think? Retrospectively or prospectively? Errors correction. Retrospectively. And because you are doing the error correction retrospectively, so what will happen? The disclosure gets triggered under the quarter because this is a material item, right? Change in the business or economic circumstances that affect the fair value of any of your financial assets or liabilities. Yes. Any loan defaults, breaches on any of the loan agreements, right? Yes, because this is a material item, can turn your non-current liability into the current. Related party transactions which have occurred during the quarter. Yes. Related transfers between the levels, between the fair value hierarchy, level 1 to level 3, level 1 to level 2, and vice versa. Yes. What led those changes? You need to explain in the disclosures. Changes in the classification of the financial assets as a result of change in the purpose of the use of those assets, right? So all such changes, are material, which are getting recorded or impacted in your results, in the quarterly results, needs to be explained in terms of notes to accounts or the disclosures, so that users of the financial statements will be able to comprehend what exactly has happened during the quarter, right? That's the sole purpose of quarterly reporting, right? Perfect. Then there could be some other disclosures as well, right? For example, statements should be made available to the users of the financial statements on the same terms as the interim financial statement at the same time. Otherwise, the interim financial reporting shall be considered as incomplete. So, we need to incorporate by cross-referencing from the interim financial reporting to some other statements such as management commentary or risk report. So if there are any disclosures which are given in the interim financial reporting, then we need to cross-reference with some other, statements from where it is sourced from, right? Otherwise, it will be rendered as incomplete interim financial reporting. Now, what you are going to prepare? Again, you are going to prepare the same things: balance sheet, P&L, statement of changes in equity, statement of cash flows as a interim financial reporting, financials set, right? So that's all was the quick recap on the Ind AS 34. You must have already discussed in your regular session. Now let's deep dive into certain practical questions on this standard and see how we are going to apply this standard practically. So I'm just withdrawing and resharing the screen. I hope the screen is up. If you can confirm quickly in the chat box. Okay, thank you for the confirmation. Yes, about 5. Okay, so the question 1. Fixed production overheads for the financial year is 10,000. Normal expected production for the year after considering the plant maintenance and normal breakdown, also considering the future demand of the product, is 2,000 metric tons. It is considered that there are no quarterly seasonal variations. Therefore, the normal expected production for each quarter is 500 metric tons, and the fixed production overheads for the quarter ended are 2,500. Now, in the first quarter, the quantity produced is 400, second quarter 600, third quarter 500, fourth quarter 400. Total 1900 is the quantity actually produced during these 4 quarters, right? Presuming that there are no quarterly or seasonal variation, calculate the allocation of the fixed production overheads for all the 4 quarters as per the Ind AS 34, read with Ind AS 2 inventory. Will the quarterly results affect the annual results? So are you trying this quickly? I can wait for few minutes if you want to try. Very small and straightforward question. Simple. Little bit of the calculation stuff is there. Nothing more than that. Any luck with the answer? Okay. Rupees 5 per metric ton for each quarter. Okay. Let's see. So if it is considered that there is no quarterly or seasonal variation, then the normal expected production for each quarter is 500 metric tons only, right? And the fixed production overheads for the quarter are 2,500. Fixed production overhead needs to be allocated basis on the per unit production in each quarter, right? So it will be 5 rupees per metric ton, right? As per the planned production. But for the first quarter, actual production is how much? 400 units, right? So for the first quarter, how much allocation will happen? 400 into my 5, 2,000 rupees, right? So unallocated production overheads to be charged as a expense as per the Ind AS 2 on in the P&L, right? 500 rupees. Is that clear? So you will be loading 2,000 rupees only on the inventory, but 500 rupees will be charged in the P&L as an expense, right? In the second quarter, how much is the production? So production is 600, right? So in this case, what will happen? Actual production on year to date basis 5,000. Total production is 1,000. 400 plus 600 and 5 rupees was the charge rate. So 5,000 should be the cost, right? So what will happen? Earlier 500 was not allocated to the production in the first quarter. To give effect to the entire 5,000 to be allocated in the second quarter as per Ind AS 34, 500 are now reversed by way of a credit to the P&L and the loss of the second quarter, right? So now this will be credited and to the P&L and debited to the cost of the inventory, right? Third quarter, what is the actual production? Actual production is 500. Accumulated year to date production is how much? 1500. 400 plus 600 plus 500. 5 rupees is the absorption rate. So no further adjustment is required. Simply it will be 7500 will be absorbed in the third quarter. And in the fourth quarter, what will happen? How much is the quantity? Again, 400, right? In the quarter four, it is given as 400. Now what will happen? Again, the total quantity year end is 1900 into my 5, 9500, right? So how much absorption can happen? Only 9500. So 500 will go to the P&L in the quarter four, right? So any of the unallocated production overheads, right, are expensed in the statement of the profit and loss as per the requirements of Ind AS 2, right? So this is the interplay of Ind AS 2 and Ind AS 34. So Ind AS 34 says that whatever is happening in the quarter has to be part and parcel of that quarter. Ind AS 2 says that we have to compute the cost of the inventory basis on the absorption rate, which we have calculated basis on the planned production, right? So if we are doing the lesser production, then the lesser absorption will happen. Remaining portion will go to the P&L. That's what the Ind AS 2 says. Clear? Perfect. Let's try this one. Narayan Limited provides you following information and asks you to calculate the tax expense for each quarter, assuming that there is no difference between the estimated taxable income and the estimated accounting income. Estimated gross annual income is 33 lakhs, inclusive of the capital gains of rupees 8 lakh. Estimated income of the quarter one is 7 lakhs, quarter two 8 lakhs, quarter three, including estimated gains of 8 lakhs, 12 lakhs, and the quarter four 6 lakhs. On the capital gains, the tax rate is 12%. On the other income, first 5 lakh 30%, balance income 40%. Now, how you would be giving effect of the tax amount in each of the quarters? So you need to calculate the tax amount which you will be recording in each of the quarters, quarter one, quarter two, quarter three, quarter four. Would you like to quickly try on this? Just try it carefully. Don't do things in hurry burry, right? Because if you do the mistake, it will erode your confidence while you must have been practicing a lot already, right? Okay, so you are saying, Samanathan, that weighted average tax rate is 38%. Okay. What is the tax expense for each of the quarters? Q1 7 lakh into my 38%, 26, 2 lakh 66,000. Q2 8 lakh into my 0.38. Okay, understood your logic. So let's see. So as per the para 38C, right? Do we need to remember the para numbers? No. As per Ind AS 34, income tax expense is recognized in each interim period based on the best estimate, right, of the weighted average annual income tax rate expected for the full functional year. So what the standard requirement is, the concept, we need to understand, right? So calculations is the secondary. So India's 34 says that whenever you are calculating the tax expense for the quarter, right? So what you need to do, you need to compute the weighted average income, annual income tax rate, which would eventually be calculated basis on the expected, income which you will be deriving for the full year, right? And what would be the income tax expense? So income tax expense divided by the total income, right? So that would be regarded as your weighted average annual income tax rate. Now, if different incomes tax rates apply to different categories of income. For example, capital gains tax are usually taxed at 20% or 30%. General income is taxed at 30%, right? And 40%. So basis on the slabs. So because of that, we need to calculate the, first of all, the income tax expense for the total income. So estimated annual income exclusive of the estimated capital gain is 33 lakhs minus 8 lakhs, 25 lakhs, right? On this 25 lakh, on first 5 lakhs, the rate is given 30%. On the remaining, rate is given 40%. So basis on that, what is our rate? So 1,50,000 plus 8 lakh, 9,50,000. So 9,50,000 would be the amount that would have been the income tax expense for the normal income for the full year, right? Now, what would be the average weighted average rate arrives in that case? 38%. 950 divided by 25, because 25 is my normal income other than the capital gains. So 38% is the weighted average rate. Now, for the Q1, do I have the capital gain income? No. So 7 lakh into my 38%. For quarter two, do I have the capital gain income? No. 8 lakh into my 38%. For quarter three, do I have the capital gain income? Yes. 8 lakhs. What is the total income? 12 lakhs. So 12 lakhs minus 8 lakh. On 4 lakh, it would be 38%. And on 8 lakh, it would be the capital gain specific tax rate. Because this specific income is being realized or earned in the quarter three, so it will be taxed in quarter three only, right? So for 8 lakh, it will be 12%, and the total tax comes to 248. And for the quarter four, anyway, 6 lakh is the normal income, normal tax rate, weighted average rate is 38%. So this is how for each of the 4 quarters, we would be computing the tax amounts. Were you all the way correct in this, Samanathan? Perfect. Nice to see that you are doing all the questions correctly. It showcases that you have done a lot of practice at home already. Okay. So are we able to understand the concept behind these calculations? So first of all, we will segregate the different income which is taxed on a different tax rate, right? So we are not considering that. The remaining income for the full year, we will calculate the tax weighted average tax rate. And then for each of the quarters, how much the general income we have, we will apply simply that weighted rate. And for the special income, which is taxed at a special rate, we will be calculating at the tax amount for that income on that very rate for that very quarter in which that was earned, right? So this is the whole sole approach we need to take while computing the income taxes for each of the quarters, right? For the year end, there is no difficulty, but for the quarters, it is, a different case, right? Okay. Let's do question number 3 now. An entity report quarterly earns 1,50,000 pre-tax profit in first quarter, but expects to incur loss of 50,000 in each of the remaining 3 quarters. So 1,50,000 is the profit they are expecting to earn or earning within the first quarter. And in the remaining 3 quarters, they are expected to operate in 50,000 losses. So at the end of the year, the income is nil. The entity operates in a jurisdiction in which the estimated annual income tax rate is 30%, the management believes that since the entity has zero income for the year, its income tax expense will also be zero for the year. State whether the management view is correct or not. If not, then calculate the tax expense for each of the quarter as well as for the year end. Straightforward, right? Correct. So management is not right in his view on this. Why? Because we cannot say that because we are earning zero profits by the year end, hence we don't have any tax liabilities in the quarters as well, right? So we cannot say so. Each quarter is a individual reporting period. And if in that quarter we have the income tax expense would be required to be calculated, correct? So each quarter has to be treated as an individual reporting period. So now, what is your answer on this? So you're saying for the Q1, 1,50,000 into 30%, 45,000. Q2 reverses the loss of 15,000. Okay. Q3 and Q4 are also like Q2. Okay. Let's see. So how the calculation will happen? So earnings are 1,50,000. Tax rate is 30%. So 45,000 would be the tax expense which will be recorded in the Q1. So management contention of recording no tax expense while preparing the quarterly one financial statements is not correct. As per Ind AS 34, we cannot do the teaming leading, right? We cannot postpone or adjust the quarterly income with the expected losses of the subsequent quarters and vice versa. So for the quarter, it stands as an individual reporting period. And for this, if we have the income, tax expense will have to be calculated for this quarter. For the next quarter, we are incurring a loss of 50,000 for Q3 as well and for Q4 as well. So in those cases, what will happen? The tax expense will go and reduced, right, in subsequent quarters, right, by 15,000 each, right, in the next 3 quarters. So what is the guidance given by the standard? Again, as per para 30C of the Ind AS 34 interim financial reporting, income tax expense is recognized in each interim period based on the best estimate of the weighted average annual tax rate. Now, in this case, our weighted average annual tax rate is also same 30%, right? Because we do not have, factors affecting that rate. Accordingly, the management's contention that since the net income for the year will be zero, no income tax expense shall be charged on a quarterly basis is not correct. Since the effective tax rate or the average annual income tax rate is already given in the question at 30%, the income tax expense will be recognized in each of the interim quarter based on this rate only. And hence, we need to proceed with the income tax expense computation for each quarter separately, even if there wouldn't be any income tax liability for the whole year, right? So what is the concept emerging out of this, standard? The concept is we have to treat the quarter as the individual reporting period, right? Now, Manish is asking what would be the accounting entry for this, right? What is the accounting entry? You tell me. So for booking the tax expense, what is the entry? P&L debit to provision for tax, right? The tax liability. Now you are reducing. So what you will do eventually? Tax liability or the tax provision debit to profit and loss or the tax expense, the notional account, which you must have been using, right? Just opposite. Clear, Manish? Perfect. Let's do the question number 4. An entity's accounting year ends on 31st of December, but its tax year ends on 31st March, right? So company is preparing the financial statements for the calendar year, but as per the income tax, the year ends at 31st March, the financial year. The entity publishes an interim financial reporting for each quarter for the year ended 31st December 2019. The entity's profits before tax is steady at rupees 10,000 each quarter, and the estimated effective tax rate for is 25% for the year ended March 19 and 30% for the year ended March 20. how the related tax charge would be calculated for the year 2019 and the quarters. Yes. Do you want to give it a try quickly? Because more we try ourselves first, increases our confidence. So Saminathan is saying for the Q4, 18, 19, 2500 tax rate, it's 25%. Okay. Manish, you are also trying it. For the Q1 to Q3, 1920, the tax rate is 30%. Hence, 3000 is the tax expense for each of these quarters. Okay. Okay, let's see. So for the quarter ended 31st March 2019, how much is the profit? 10,000. What is the tax rate? 25%. So 7,500 would be the profit after tax. So tax charge is 2,500, right? But for the quarter ended 30th June, 30th September, 30th December, and 30th December 2019. So what is would be the income? 10,000, 10,000, 10,000, and 10,000, total up to 40,000 for the year end, right? So for these 3 quarters, the tax expense would be calculated at 30% tax rate because it is effective given in the question for the next year. So 7,000 would be the profit after tax and 28,500. So this is how the picture for each of the quarter and the year end will be coming through. Clear? Now, why we have applied the different rates? Because the accounting year and the tax period year are not same. So there might be different income tax rates which might need to be applied for the periods falling within those, financial years, right? So that's the logic behind this, right? Otherwise, it would have been on the same income tax rate, right? Because the tax rates are coming from two different financial years for this calendar year. That's why. That's the reason. Correct? Now, what we have learned from this question. So we have learned from this question the tax rate which is effective for that quarter as per the income tax, right, needs to be applied for that very quarter, right? So if the rate changes in between, then are we supposed to apply the new rate? Yes. Although it doesn't happen in general, but I'm just asking hypothetically, if during the mid-year government comes and changes the income tax rate, then would you be applying the revised rate which is made effective? Yes. So that's the logic. So whatever the tax rate is effective for that quarter has to be considered, right, for the purpose of our calculations. Let's do this one. PQR Limited is preparing its interim financial statements for quarter 3 of the year. How the following transactions and events should be dealt with while preparing the quarterly results? It makes employer contributions to the government sponsored insurance funds that are assessed on an annual basis during the quarter 1 and the quarter 2. Larger amounts of the payments for this contribution were made while during the quarter three, only some minor payment is made. Since the contribution is made up to a certain maximum level of earnings per employee, which had already been achieved because of the higher contributions in the prior quarters, and hence for the higher income employees, the maximum amount income reaches before the year end, right? So because of this, the contribution in the quarter three is less as compared to what has been done in the Q1 and Q2. The entity intends to incur a major repair and renovation expense for the office building. For this purpose, it has started seeking quotations from the vendors. It also has tentatively identified a vendor and expected cost that will be incurred for this work, right? So some major repair work is expected to be done in the quarter. The company has a practice of declaring a bonus of 10% of its annual profits every year. It has a history of doing so. So every year company announces 10% bonus and it has a history of doing so. Now, management is asking you as a chartered accountant to advise them how to deal with these three matters while preparing the quarterly financial statements for the quarter three. What is your suggestion on these three matters? Yes. Any responses? So Saminathan is saying in the case of one, like income tax weighted average rate, we will have to do it for this item as well. Okay. Others? And item two and item three? What is your response? For item two, you are saying not to record expenditure related to the future event. Okay. Manish is saying expense should be recognized in the quarter in which it is incurred. Okay. What about the bonus? 10%. What you are going to do for that? Any suggestions? Treatment of the bonus which the company pays to all its employees at the rate 10% every year. So Samanathan is saying because it has the past record, we need to accrue this bonus in the quarter three. Okay. Manish is saying bonus has been recognized spread the whole year. Okay. Let's see. Now, just one request to everybody. Since we are preparing for our CA final examination, right? So although we might be answering correctly for all these theoretical questions or case based questions, but articulation is also important, right? To get the full marks, right? So if we are not good in articulation, then we need to practice that a lot also, along with being right on the answer. So I don't say that you need to mention the para number, but always try to start with your answer with the relevant standard to which the theoretical case is related to, right? So if you are not mentioning even the standard number, do mention the standard name at least. If number is not, you are able to recall, right? So if you are at least able to recall the number of the standard, do mention that, right? Because it shows your confidence in your answer that yes, you have understood the facts correctly. You picked up the right standard to which the facts are related to, because in the class we know for a fact that we are talking about India's 34th, and hence we are thinking through the lenses of India's 34 only, all the facts. But in the examination, we wouldn't be knowing from which standard or from which group of standards the question is designed, right? So we need to understand basis on the facts of the question in the examination. All if we are able to crack it clearly, then always start saying that, right? So as per the India's 34 interim financial reporting, the standard states that an entity shall apply the same accounting recognition and measurement principles in the interim financial statements that are applied in its annual financial statements, right? So this is the general statement. You can always remember and use it in your examination for these type of theoretical questions. Then you will say, as per the standard, forget about the para numbers, because I don't want you to spend unnecessary time learning these para numbers. As per the standard, interim financial reporting state that for assets, the same test of the future economic benefits apply at the interim dates and at the report as at the end of the financial year. Costs that are by the nature would not qualify as assets at the financial year would not qualify at interim dates either. Right. Similarly, a liability at the end of the interim financial reporting period must represent a existing obligation on that date. Right. Otherwise, it is not to be treated as a liability, right? India's 37 says present obligation. So if you do not have the present obligation, liability is not required to be recorded because the key is present obligation. Essential characteristic of income, revenue, and expenditure is that related inflows and outflows of the assets and liabilities have already taken place. If those inflows or outflows have taken place, the related revenue and expenses are recognized, otherwise not. The conceptual framework does not allow the recognition of items in the balance sheet which do not meet the definition of the assets or the liabilities, right? So this is the general discussion we have to make, right, in order to explain or support our answer. So it's not that if we are giving the right answer, that is enough. We have to support that as well, right? I'm not saying you need to write unnecessarily long paras and waste your crucial examination time, but at least try to support within a line or two lines, right? Now, considering the above guidance, let's talk about each of the case. If the employer contributions to the government sponsored insurance funds are assessed on an annual basis, the employer's related expense is recognized using the estimated average annual effective contribution rate in the interim financial statements, even though the larger amounts were deposited or larger amounts of payments have already been made in the earlier quarters in the financial year. Accordingly, it should work out as an average effective contribution and account for the same accordingly in the interim financial, right? So this is the approach that we are going to follow while answering. Although your answers were correct, I'm just emphasizing that approach also we need to learn, right? The cost of the planned overall expenditure that is expected to occur in the later part of the year is not anticipated for the interim reporting purpose unless the event has caused the entity to have a legal or constructive obligation. The mere intention to incur some expenditure in the future does not give rise to a obligation, right? Because as per India's 37, condition is present obligation. If obligation is not present, then there wouldn't be any liability, and there is no liability, so there is no expense, right? So for the future plans, we are not going to pass any journal entry. Otherwise, the management is thinking a lot of things in their head, which they might be actioning in future. Are we supposed to pass the journal entries for all the thoughts they have in their mind? No, right? Third item, bonus. A bonus is anticipated for interim reporting purposes if and only if the bonus is the legal obligation or the legal obligation or past practice that would make the bonus as a constructive obligation. So as per Ind AS 37, you must have read that either there has to be a legal obligation or there has to be a constructive obligation, right? For which there is no realistic alternative the company has but to make the payments. So in the present case, because the bonus is not a legal obligation, the company and the employee have not signed a contract that the company will pay the bonus every year, but because of the past behavior, company has set up a constructive obligation. And as per Ind AS 37, right? Provisions, contingent liabilities, and contingent assets. Because the constructive obligation condition is meeting, so we need to record a liability, right? A reliable estimate of the obligation can be made, and under which standard Ind AS 19 employee benefits provides guidance in this regard. What that standard says, a liability for bonus may arise out of the legal agreement or the constructive obligation because of which it has no alternative but to pay the bonus accordingly needs to be accrued in the annual financial statements. Bonus liabilities accrued in the interim financial statements on the same basis as they are accrued for the annual. So in the instant case, bonus liability of 10% of the operating profit for the year to date may be accrued. What do we mean by this statement? So 10% for the year to date profit, YTD profits. So if we are recording it in for quarter 3, then what is the accumulated profits as on Q3, right? Suppose 10 crores in Q1, 20 crores in Q2, 30 crores in Q3. So 30 plus 20 plus 10, 60 crores. So on 60 crore, 10% will be computed, right? And that liability will be recorded, right, in the Q3. Correct? Is that clear? So answer was right for both Saminathan and Manish, but how we are going to present the same also makes the difference in the marks, right? That's what we have learned in this question. Clear, everybody? Any questions, any doubts anybody wants to ask at this stage or any confusions? Okay. Let's try question number 6. While preparing the interim financial statements for the half year ended 30th September 2002, an entity discovers a material error, an improper expense accrual in the interim financial statements for the period ended 30th September 2001 and the annual financial statements for the period year ended 31st March 2002. The entity does not intend to restate the comparative amounts for the prior period presented in the interim financial statements as it believes it would be sufficient to correct the error by restating the comparatives in its annual financial statements for the year end 31st March 2003. Is this acceptable? Discuss in accordance with the relevant Ind AS. Okay, tell me your answer. Management contention is correct? No, right? Which all relevant standards will come into play? If this is your question in the examination hall, which all standards you would be thinking of to answer this question? So Ind AS 8 will come into play because we are talking about the prior period error correction, right? And that is dealt by Ind AS 8. Now, because this error correction is happening within the quarter, so Ind AS 34 will also come into play, right? Because Ind AS 34 talks about the interim financial reporting. So Ind AS 8 in conjunction with Ind AS 34 is this case, right? Okay, what is your answer now? How to go about this error correction? Yes. How to go about this? One line, two lines, whatever you want to say. So correct the error within this quarter. Apart from correction, anything else we are obligated to do? Disclosures within the quarter for the error correction? Yes or no? Right? Because it is an error correction, which is a material item, right? So as per the para, now how we are writing this answer in the examination, right? So that is also a key to learn. As per the para 42 of India's 8, inter alia states that an entity shall correct the material error, prior period errors retrospectively in the first set of the financial statements approved for issue after the discovery of the error, right? As and when the error is discovered. So whatever the financial statement we are going to publish after the discovery, be it quarterly or be it and half yearly or be it annually, right? Whichever the first financial statement we are going to publish or release, right, to our users, that financial statement has to, give effect for the correction of this error. And correction of error always, done retrospectively, right? And we need to reinstate the comparative amounts as well for the prior periods to which the error has impacted, right? And in which the error has occurred actually, right? Paragraph 28 of the Ind AS 34 requires an entity to apply the same accounting policies in the interim financial statements that are applied in its annual financial statements, except for the accounting policy changes made during the made during the quarter as compared to what the most recent financial statements, right? And are to be reflected in the next annual financial statement, right? So if there is any accounting policy change, we need to do that. Paragraph 15b of India's 34 cites correction of the prior period errors as an example of the events or transactions which need to be explained in the entity's interim financial report if they are significant to the understanding of the changes in the financial position and performance of the entity since the end of the previous reporting period, last annual reporting period, right? Because we are correcting a material error, so we need to explain this as well to the users of the financial statements in form of disclosures within the quarterly results, right? Condensed financial statements and explanatory notes, right? So that users will be able to comprehend what actually went wrong and how did we correct it, what is the impact on our P&L, right? And how it is going to impact our annual financials, right? Para 25 of Ind AS 34, interim financial statement states as follows. While the judgment is always required in assessing the materiality, this standard bases the recognition and disclosure decisions on the data for the interim period by itself for reasons of understandability of the interim figures. Thus, for the example, unusual items, changes in accounting policy, estimates or errors recognized and disclosed on the basis of the materiality in relation to the interim period data to avoid misleading inferences that might result from the non-disclosure. Now, whether the error is material or not, that will be looked at basis on the interim period reporting data, not for the full year. So for the full year, suppose you are having a 1 lakh crore revenue and for the quarter you are having a 20,000 crore. So materiality has to be assessed for the quarter in relation to 20,000 crore or for the full year revenue. So for the 20,000 crore, right? So that is stated by paragraph 25 of the Ind AS 34. That materiality for the quarter has to be basis on the numbers of the quarter, not for the full year, right? In view of above, the entity is required to correct the error and reinstate the comparative amounts in the interim financial statements for the half year ended 30th September 2002 and needs to give the selected explanatory disclosures and notes to explain what went wrong, how it is detected, how it is corrected, and what is the impact on the current year profitability and the EPS, and what is the impact on the overall profitability for the full year. Is that clear to everybody? So I hope whenever I talk about the key learnings from the practicals, right, I expect that you were noting down somewhere on your writing pads or the notepads, Google notepads or whatever you are using, right? So that you can quickly revise those key learnings instead of doing all the questions on the examination day, right? Because we don't have that luxury time to revise all the concepts by actually doing the practical questions. So whatever we are learning from these practical questions, we should keep a separate register to learn, to note register for those learnings, right? Any questions or anything which you might be struggling with, you want to discuss or ask in relation to India's 1 or India's 34 conceptual clarity, or any questions you which you were doing and you have some doubts, I'm happy to discuss as well in case you want to ask. Okay, tell me, just summarize key learnings from the today's India's 34 discussion, because India's 34 is very unique and crucial standard. So sometimes we think that this is not very important standard, but in from the examination standpoint, India's 34 is very important because it requires you to make the adjustments, or make the recognition and measurement for the quarter itself, right, rather than assuming it would be spread over the year, right? So whatever is belonging to a particular quarter has to be recognized within that quarter itself, right? And for certain items it asks you to calculate the spread uh, approach, right? For example, the tax expense, right? So for tax expense, you calculate the weighted average tax rate first, right? Then you apply the that rate on your quarterly income, right? In order to calculate the tax expense, right? For any other expenditure, for example, the repair, maintenance, and expenditure, which we just discussed. So how do we recognize the repair, maintenance expenditure? As and when that is incurred. So if the management is planning to incur some expenditure in the future, then we will not say that because this is the plan and the plan has been done in this quarter, so let's record this or make a provision. So we never make the provision of the repair maintenance expenditure. Repair maintenance expenditure are always recorded on actual basis as and when they are actually incurred, right? And they will be recorded in that very quarter in which they are incurred, irrespective of the fact that the amount was big or the significant. So we cannot split it over multiple quarters, right, to streamline the impact of that expenditure, right? Then the bonus item which we have discussed. What was the learning from the bonus? Since bonus is the annual payment to all the employees coming out of constructive obligation. Now for each quarter, do we have the constructive obligation? Yes. Although the payment becomes due at the year end, but are we following the accrual method of accounting or the cash basis of accounting? We are following the accrual method of accounting, right? So we have to accrue that expenditure which is to be paid, you know and because the bonus has to be paid to the employee, and employee is rendering the service to the company in this quarter as well. So for this quarter we are getting the services of the employee, hence we have the liability to record the expenditure we are incurring on those employees. And expenditure on employee doesn't only include the salary or the wages, right? It also includes other emoluments which are payable to employees, irrespective of the fact whether they are payable on a monthly basis or payable on a quarterly basis or payable on an annual basis, right? So the only payment frequency of the bonus is the annual, right? So you might be getting, some people might be getting confused that bonus is payable at the year and why we are recording it on the quarter, right? So the logic behind that is employee has rendered you the service in the quarter, yes or no? Yes. So for that service, are you paying the benefits to the employee? Yes. Employee benefits as per India's 19. India's 19 says employee benefits includes all the payments all types of payments made to the employees in the capacity of the employee, right? So it includes the salary, it includes the wages, it includes any other deposits or contributions you are making on behalf of them, for example gratuity or pension contributions. It includes the insurance premium if the company is incurring any for their employees. It includes the bonus as well, which is payable at the year end. So we shouldn't be getting confused with the payment frequency, right? So payment frequency could be the monthly, like salary, wages, which are paid every month, contributions are paid to PF or ESI every month, right? Or it could be annual, like bonus is discharged on an annual basis, right? So payment frequency shouldn't be driving your accounting, right? You are accruing the expenditure by virtue of getting the services from the employees each day, and hence you are bound to record those expenditures which you have committed to pay to the employees in lieu of their services, and bonus is one of them. Is the concept now clear? If there was any confusion by any chance. Then another item which we have learned from today's practicals is the allocation of the fixed overheads, right? So we come up with a uh, absorption rate calculation in advance basis on the planned production output, right, for the year. But if we are achieving less or more production outputs, then how the expenditure will be allocated on the inventory cost. So it is basis on the actual, right, rate, right? So rate is calculated, was calculated in our question was 5 rupees, right, basis on the planned production. So it will be applied on the actual units produced during the quarter, and the remaining will be charged to the P&L. It will not be loaded to the cost of the inventory, cost of goods sold, right? But if we are producing more, then it will be up to the amount of the charge rate, right? And if there is any reversal, that will be adjusted within the next quarter, right? So these are all the key learnings which we need to record somewhere, register somewhere for our quick revision going forward. Any questions, Samanathan or Manish or any other? Anybody wants to ask anything? Okay, perfect. So are you liking these sessions, LVRC sessions? Are they useful for all of you to do the quick revision in the morning so that you can kick start your day with quick concept revisions as well as the practical questions which we are doing in these classes? Thank you, Samanathan, for your feedback and the appreciation. Okay, so if there are no more questions uh, you have, then probably we can wrap up the session. Not sure if Shilpa ma'am is joining for the closure. Okay. So let me quickly ask you one question. What are the key difference in India's 1 and India's 34? Suppose if this question, somebody ask you, what are the key differences between India's 1 and India's 34? What would be your answer? Just before we log off, I thought to have a distinction between the two standards quickly. Because today both the standards we have discussed in detail, right? And I have talked about the key requirements from both the standards. Now, if somebody asks you plain vanilla question, what are the key differences between India's 1 and India's 34? What would be your answer? So India's 1 drives the presentation requirements for the complete set of the financial statements. India's 34 drives the minimum presentation requirements for the condensed financial statements for the interim financial reporting. That is the one, right? What else? So India's 1 requires, all the explanatory notes to be forming part of the financial statements, full-fledged notes to accounts. India's 34 says selected significant explanatory notes related to the events and transactions, significant events and transactions occurred during the interim period, right, for which you are preparing the financial statements. So that is the another thing that deviates, between the two standards requirements, right? So India's 1 requires you to talk about all the items, all the standards disclosure requirements. India's 34 says all the key explanatory notes. It is not requiring you to disclose all the disclosures required by all the NDSs, right? So that is the another difference. Anything else? So whenever we are preparing the full-fledged set of financial statements, India's 1 will apply and is India's 34 will go away, right? So as long as we are preparing the quarterly or interim financial reporting in terms of the India's 34 condensed financial reporting, the we are going to apply India's 34. But if we choose to prepare the full set of the financial statements, even for the interim financial reporting, then we have to apply the India's 1 only, right? So then India's 1 becomes fully applicable in that case. right? So that was all. I wish you all the very best for your examination. See you as a qualified chartered accountant soon. Thank you. Session is over, Ashok ji.